Hi everyone, welcome to the Digital Fifth Fintech Show. Today we have with us Ganesh, who is a co-founding partner of Quona Capital. Quona Capital is one of the first fintech-focused investment firm in the world and has investments in multiple entities, including Zest Money, SME Corner, as well as Fisdom. In fact, interestingly, Fisdom founder also had a podcast with us yesterday. So I think great to understand his perspective. And since they've invested across the world, we'll also get a context of India as well as outside. So, welcome to this show, Ganesh. So, I think before we start, Ganesh, I want to know a lot about what you are all about. Your company is all about. What exactly are your investments? So, good details will be useful for us.
Sure. Thanks, Samir. Thanks a lot for having me. I guess we are in really interesting times, and this discussion is probably it's probably never been more apt than now.
I agree.
So Quona is a firm we started about almost 6 years ago now, and Quona Capital was formed by three of us founders, who came together with sort of very common theme, which is we had our own experiences as tech and fintech entrepreneurs, have been investors in Valley and across more evolved venture ecosystems. And I started my venture career in the Valley with a fund called Greylock, and also had all been investors in financial inclusion, which we believe in very firmly before we came together. So there are a lot of common things which brought us together, and that's what sort of helped us launch Quona, which probably is the first fintech only VC fund for financial inclusion. We invest exclusively in emerging markets and pretty broad spectrum across emerging markets between Asia, Africa, Latin America, and Middle East.
Okay.
And our top countries, we are active across 12, now maybe 13 countries. The top countries of investment are India, Brazil, South Africa, and Indonesia, Mexico, and Southeast Asia generally is emerging as a fast evolving market for us. But India is certainly a market where probably we have 1/3 of our investments. We have three active investment pools right now, and total about 30 active investments across SME lending, consumer lending, financial advisory, payments, wealth management, cross section of commerce and fintech, mobility and fintech, education and fintech. So a lot of adjacencies of financial services, because our fundamental belief is that we back companies that are that are enabling financial innovation for an end goal, for an end need or end purpose, especially for the masses and the lower income. So from that perspective, a lot of the companies we back, if not all, are towards an end goal, and that's why you'll see a lot of adjacencies. And the companies in our portfolio in India, active and past ones, include, you mentioned some of them already. Zest Money, of course, which is one of the largest digital consumer finance companies. SME Corner, which is a fast-growing SME lender. Fisdom, one of the larger wealth tech platforms. Neo Growth, which is the largest retail SME lender probably in the country. India Mart, which went public last year, and probably the largest SME commerce platform in the country. And we had a portfolio company called Shubham. It's an affordable housing finance company, and we exited Shubham about 2.5 years ago. So those are probably the most active portfolio companies in India since we launched Quona. And prior to Quona, of course, and after my Valley investing experience, I worked deeply in financial inclusion and microfinance, and used to manage a fund called Unitas, where we back a lot of microfinance companies which are all today SFBs, whether it's small finance banks, whether it's Ujjivan, Equitas, Bandhan, SKS, so on and so forth. Excuse me.
Excellent. I think it's a good perspective. And okay, just one more point. Beyond India, what are the key investments you've done, which will also give a perspective when you talk about the impacts?
Sure. So the key countries of investment, I think we have three concentric circles. The most active concentric circle is the innermost circle is India, Brazil, South Africa, and Indonesia. Next concentric circle is probably it includes Mexico, Nigeria, Kenya, East West Africa corridor, and Philippines and Thailand. And then the outermost corridor would be the newer experimental market, which is rest of Southeast Asia, the rest of LATAM, which is the Andean region, and also Middle East, where we are very close to making an investment in Turkey, which will probably be one of our first Middle East only, or rather, I'd say MENA only sort of investment to kick that off. But those are the primary countries of focus.
Okay. Okay. So, given that we have already been through this COVID journey now, I think two months already. We were knowing about it. Now we are seeing it very, very closely. So, what do you see from a pure customer perspective, and obviously with some focus on financial services? So, what will be the behavior change in terms of customers, in terms of buying behavior, in terms of maybe going for credit? What exactly will the behavior change?
Yeah, it's a good question, Samir. I think it's anybody's guess, and I guess none of us have the crystal ball. But
I agree.
we are already seeing across portfolio companies, some interesting shifts. And like I said, our portfolio companies have a crossover across a lot of different sectors. It's financial services at the core, but it covers retail, education, healthcare, commerce, mobility. Across sectors, we see portfolio exposure. I think we kind of categorize the changes that are likely to happen in three parts. One is the short term. The second is probably more possibly more secular change, but which will require a nudge. And then some things which are fundamentally going to change more because since people have been forced to adopt to those changes, they realize it's easier than they thought. So I think it's still we're still figuring out what kind of changes will fall in what category, right? And we all know a lot of the examples where people are suddenly, especially some of the earlier startups or even mid-stage startups have realized that you don't need to have sort of infrastructure to the extent you thought you needed to. You can manage people between remote and in the office in a smarter way. You can manage customer communication in a smarter way. You don't have to always make it physical. Of course, you take lending, people are trying to re-evaluate a lot of things they did physically in terms of how to do it differently now because they are forced to. So I think some changes will be really flash in the pan and short term, and I don't think they will stand the test of time. Some changes which will be fundamentally secular, and there are some big bets happening right now as we speak on customer comfort or patient comfort around a lot more digital consultation or online digital courses when it comes to education. Now, whether it will work the same way for vocational versus postgraduate versus graduate versus K-12 versus primary, I think that's to be seen. But we are seeing a fundamental secular change where everyone is being put through that litmus test. I think, and then there are some changes in the middle. So we think the changes in the middle are really the opportunity where the entrepreneurs are willing to take initiative. Those can really step on it, get more aggressive, and really help make these changes happen, which will then work to their advantage. Where competition may not be able to catch up to it as fast as they would have. Can you really take a change, a behavioral change, and reinforce it to your advantage? I think that's something we are trying to explore across portfolio companies.
No, I agree. I agree. I think as we spoke, so we were never taking our training online, and the impact we are seeing is amazing. So we have, for example, open banking session this week again. Last week we had on fintech, and it is almost full even before we sort of started out. So which is much better than what we were doing. And from a customer perspective, the costs are much lesser because they don't have to travel anymore. And we also don't have to focus on their accommodation and stuff like that. So I think things have become cheaper and simpler that way. And I guess the cost structures will also change because, for example, whatever consulting costs were there, we had a lot of cost of meeting the customer and spending that time, right? I think that is coming down because people are becoming far more efficient with the Zoom call and others, right? The documentation levels are increasingly improving because when we now chat, they come back with documentation saying that this is what we want to work on. Can we start? So I think we are seeing that change as you're talking about. So fantastic. I think we are also learning back. Everybody's learning. So key thing from a segment perspective, since you are advising founders in different segments across SME lending or a retail lending or a payments and others, what is your advice? What should sort of founders do in this current scenario so that they can actually take the opportunity forward and obviously cut down where the losses should not happen, right? So they have to be careful with it.
Yeah, it's again a good question. It's probably the crux of what everyone's trying to figure out right now. I guess if you look across our portfolio companies and also several companies that we have engaged with in the ecosystem to help in ways we can beyond our portfolio. I guess everywhere we have advised companies to have a plan B, C, and D. I mean, the plan A is anyway gone out of the window right now. So everyone needs, we think, three plans, B, C, D. And the reason I say that is because I think whether it's people dimension, whether it's certain fixed costs which were investments for startups, or certain variable costs which are important to drive demand, or certain customer engagement efforts which were helping prime customers, you might remove it in short term, but it might leave a much more lasting impact in terms of the adversity it might create to the business when world comes back up. So I guess that's why we are suggesting plan BCD, which is at what point do we want to activate which part of the plan. And nobody knows in these situations what is overreaction, and maybe overreaction is the best reaction, by the way. Now in our case, overreaction is to say, let's take this seriously enough and say figure out how everybody can have at least 18 months of cash. That is the first goal. So guys who have raised money recently, great. Folks whose businesses are probably only marginally impacted from a revenue perspective, like Wisdom, relatively less impacted because it's annuity revenue. I think there the focus is more on how do we ensure that the investments we have made to cultivate future revenue is intact while we are managing costs, as opposed to in case of some lending companies where if RBI is given a moratorium, it's going to have a direct impact on cash flow. I mean, it may not be so much on necessarily on revenue, and hopefully when world comes back up, most people know that they have to pay back, even though that's an exercise on its own, which we'll have to figure out. But in the short term, I think some of the companies, especially lending, have a lot more of a cash flow challenge. So there the focus is on saying on two things, right? For every company, it's survivability. But for some companies, based on your revenue model, business model, customer stickiness, annuity, whether you have raised equity or debt, all of those things, for some it might be easier versus the others. So so I guess first order of business survivability. Second order of business is protecting the franchise. Now, protecting franchise means I'll give you an example from one of our lending portfolio companies, which was very smart to say well before any other company that we are not going to lend for next two months. Mm-hmm. And we had a significant debate at the board saying, okay, that's a bold decision. But in hindsight, it makes a lot of sense. And also because this company has, longer term loans. So even if you don't lend for 2-3 months, it's only going to reduce the book by 3-4 percentage points every month. You'll still keep earning if you are able to focus the resources that were doing sales more on collection. So I think everyone is kind of trying to figure out a strategy, but broadly it's survivability, then protecting the franchise, and then making sure that the investments you have made to actually prime demand, you don't cut into those investments. We have to do fixed and variable cost pruning down, and we have companies that are, actually making cost cuts up to 40-45% right now, including phenomenal founders we have great respect for in the portfolio, who are taking anywhere from 25, 30, 40, all the way up to 70, 100% salary cuts. Mm-hmm. So we have seen people sort of activating plans to say, hey, I have to lead by example if I'm going to ask my team to make this sacrifice. So I think overall people are making those efforts, but while doing that, we need to ensure that we also don't cut into bone. If you cut into the skin a little bit of the company, fine, but you don't want to cut into the bone of the company, which then structurally becomes difficult to come back up to capitalize on demand, which will be humongous when the world comes back. So you need to be ready to serve that as well. So I think that's the broad framework. But I guess there are a lot of specifics going on. If you take just cash flow as a nodal point, I think we can write probably 2, 3, 4 chapters of a book on all that companies are doing, right, to preserve cash flow.
No, I agree. In fact, we also become very, very lean in terms of cost structure. So I think the only places where beyond salary we are spending is about training and on anything which is to do with the enablement of collaboration. I think that's where we are spending. Our hiring has slowed down, We were hiring at a very, very fast pace. We would have become at least 3 times our team. We are no longer doing it. We are working with interns right now as we see the demand going forward. I think cost structure as such of the companies will change. My guess is the valuation and the cost structure both will change because both of them have gone beyond the structure. So any views on the what kind of cost structure changes do you see the companies will be looking at? Because then models will be completely different from what they are right now.
Yeah, no, but that's a good question. I guess one is obviously there is a whole people cost dimension where one can look at so many sort of different things. Some are temporal, like if you look at bonuses or if you look at increments, clearly those are not happening in this time.
Absolutely.
In most cases. So and those are temporal. So I think there's a temporal fix, and then there is natural attrition which happens in companies, and it might be a little bit more stringent in these times. I think beyond that, obviously, different companies have different philosophies on cost cuts they can do within the teams based on the culture of the company, etc. So there is a whole, I guess, science and art around the give and take between the team and the organization as a whole, and what people are motivated by. So that's one dimension. The second is, I think, if you take lending companies specifically, I think there is a lot of efficiency being rethought, and not just lending. I guess in fintechs in general, a lot of efficiency being process efficiencies being rethought in terms of KYC, AML, the front end onboarding piece. In lending companies, there is fair bit of rethinking going on underwriting front, but frankly, that again is something you'll need a little bit of a crystal ball for, because I think for at least some time we are going to have a pre-COVID and post-COVID world. And how does the credit worthiness of a certain customer segment or an SME change in the post-COVID world is unknown right now. But it is going to change. It's going to change significantly. So even our underwriting models are going to go through some changes. And folks who are not preparing themselves for that would probably be in for a root shock in terms of poor quality of origination in the first few cohorts, which by the way can sometimes push the companies back by a year and a half or two if you don't realize that. So I think the second is the underwriting efficiency and even the mechanisms used for underwriting. Third is efficiencies on the collection front. We are seeing significant innovations already in several portfolio companies. I think fourth is it's still early for the fourth, but I would say the point we touched upon earlier in terms of remote working and the dynamics of remote working, especially in companies with a lot of sales staff. I think it's being rethought. How people can deliver more effectively, how productivity can be enhanced, etc. And then, of course, there are a number of other tactical things where people are trying to figure out how to manage their payables, receivables, etc. more effectively. Another broader point probably is the industry or ecosystem or association-wide lobbying going on with RBI to get some rationality into the whole moratorium process.
I agree.
How that can be extended to the fintechs themselves, who are expected to honor the moratorium with their customers. So that, and then the last piece I would say, which probably should have been the first point, is the first point I should have made, is we have number of portfolio companies and others in the market I'm seeing who are very, in a very conscientious way, but in a very smart way, educating customers on pros and cons of moratorium.
Correct.
And I think that's been pretty impressive, whether it's in their social media communication, SMS, phone calls, WhatsApp, follow-ups, everything. They're talking customer through, hey, what is good about it and what's not so good about it. And so please understand that. I mean, it's not free money, it's not interest waived, it's not principal waived. You'll have to come and pay back. So if you have the ability to pay, please keep paying so that you are in good stead. And I think, and at least in some places, we are seeing that already resonate with customers. Like when one of our portfolio companies, I think we had a meaningful percentage of customers who had opted for moratorium come back and say we want to opt out. Now, it's still early days. I think all these things will change every week or every 10 days. But that's a welcome sign, frankly, that people understand, what they should, what they're responsible for, and whether they should go for it or not. It's like I said, it's still early days, but we are seeing all of this, right? And in different measures in different companies.
I think people are not able to understand the difference between a waiver and moratorium, right? I think it's as simple as that, because people think that government has given them opportunity to sort of let go, the way it has happened in farmer case and others, right? So in fact, my gut feel is that while you're right, these two segments obviously are impact, but I think payments as such, digital payments for sure will go up and insurance will go up. My gut feel is even neo banking kind of frameworks also will grow up, because then they are not leveraging their own capital, right? So wherever the capital is not involved, my guess is those will come back much better post this scenario. And I agree with you. I think India needs a lot of startups focused just on collections, because after 3 months, the collection needs to be so high that we would need sort of companies just focus on that. Maybe some of them have to throw off their focus on actually lending, just do collections, and we convert this into pivot that into a business itself. Maybe that is what will work, I guess.
Yeah, no, absolutely. I think the biggest uptick we are seeing already is in insurance. Now, what that means, what that translates to for insurtech and fintech companies is yet to be seen. But we already seeing whichever portfolio companies have effective distribution mechanism. We already see that they are certainly adding on insurance for their customers, and also designing micro insurance, especially on health micro insurance products relevant to the current scenario, and rolling things out, which is getting adapted by the customers at a very active pace. I think payments is a different ball game. Like you rightly said, the digital payment transactions are going to shoot through the roof. But I think the fundamental issue of whether payments is a commodity or a utility in our country, versus if anybody can really, if there's any business model left to be built, I think that question, I don't think structurally can get answered in this crisis, because the challenges still remain, in my view.
No, I think that is not to do with COVID. I think COVID-19 is what demonetization to the power 10 across, not just in payments, across board. So payments will definitely increase, and people are trained or forced to become digital now, right? I mean, nobody's trying to use cash now because of the risk involved. So I think training is happening, but the implication of business model is linked to MD or other issues, which are like completely separate.
True.
So coming back, Ganesh, I think you are one of the biggest investors in the ecosystem, right? So what's the impact on you, and how are you operating? Are you still investing? What kind of companies are you looking at? So anything right now, any thoughts on your organization itself?
Yeah, sure, Samir. So ironically, we actually announced the final close of a new fund on, I think, March 3rd or 4th.
Correct.
So we're probably the last venture fund in fintech ecosystem to announce a close before the world went into crisis. So yes, so we very much obviously have the dry powder, and we have a new fund which we are investing out of. I think so. We are very much in the market. But having said that, there are 2 points to make. One is, I guess, our first responsibility, order of responsibility, is to our portfolio companies.
Correct.
So, I mean, over these first few weeks, we are also still trying to understand the impact on those portfolio companies fully. I mean, there are some which have just done close fundraise, whether it's SME Corner or Fisdom. And there are some who did it 6 months ago, some who haven't done it for a while or were planning to do it this year. So I think taking stock of portfolio, working on our plan Bs and Cs in the portfolio, and seeing what kind of runway, what kind of a business shift that each company has to address is our first order of business. And in Asia, between India and Southeast Asia, we have 10 active portfolio companies. So it's kind of fair bit of effort when you have to, when you are on sort of high octane, all pins falling across entire portfolio, right? And that's the situation across the world right now.
Yeah.
I think we have now reached a point where there is reasonable stability across most of the portfolio companies and an outlook on what we are going to do. So we have the ability to shift attention more actively to pipeline companies or newer investments. Now, when we get into that zone, I mean, there are a lot of companies we were already under discussions, as you can imagine. Mm-hmm. But the fundamental point is, just like if we reflect what's going on within portfolio, for a number of these companies, the question also is, how is the market going to change for you in a post-COVID world? What is your own uniqueness and differentiation and business model strength to survive? What's the nature? How is the nature of demand and customer risk profile going to change? In the case of your specific solution and product, and what kind of projections can we make, even if we take the next 18 to 24 months? And today, I think if you ask anybody all these questions on March 10th, very few will be able to give you definitive answers, because it's just the way world is changing. So I think the lack of ability to answer that question, because we haven't reached a stable state on this crisis, I think makes it difficult for us to evaluate the evaluate companies from the perspective of what is possible, where is the world headed, what is possible for this company in that context, and what's a fair valuation. But I think as soon as stability sets in, we will be very much able to move, because that is our mandate. We invest only in this space, and we have a new fund, so which is only very modestly deployed so far. So I think we will absolutely move, but there has to be an ability to calibrate certain stabilization in the world to be able to build your thesis around an investment that's coming your way.
I think volatility is definitely an issue. So I think it's important that we take time to do that. But on the other side, I think you'll not have to face bizarre valuations going forward, at least for a year or so, which I think has been the case for some time. What's your take? The valuation will change for sure.
Yeah, so I just, as I was telling you, I just got off other webinar, Economic Times, and I said we were living in a world of delusional hubris,
Mm-hmm.
completely, right? And in some ways, people like us who have been investing in financial services and fintech for now, 13 years, 12, 13 years, we are very glad that the party is coming to an end. It's sad the way it's coming to an end. You would have expected course correction to happen more naturally. But if you look at one positive side of this, I think I'm glad party is coming to an end, because 2016, 17, 18, 19, I think we just were seeing a lot of absurdity in the market.
I agree.
And in some ways, we are glad that sanity will come in a few different ways. One is folks who have started Me Too models because someone has got funding. They will not stand the test of time. Secondly, folks who have already built up high cost bases without a solid revenue model or business model will come under stress, even if they have capital, because in these times, nobody wants their companies bleeding 3, 4, 5, 7, $10 million a month, not knowing what is the monetization and profitability or unit economics model. And also, some companies which were kind of commoditized, but coasting along, and I wouldn't say exactly living dead, but sort of in that category. I think those companies will also have to take definitive steps, one way or the other. Either you consolidate with somebody or you shut shop. So I think so. We think the market will sort of cleanse itself up a little bit, and also more sanity will come in. Now, I don't know how long this sanity will last, but I would be surprised if it doesn't last at least for a couple of years. So in that sense, it's sad the way the party has come to an end, but it's definitely come to an end.
No, I agree. I think we have seen, I think, as you said, last couple of years, valuations were bizarre and people were raising funds with no real model visible to the market. I'm not saying it was right or wrong, but I think somehow most of us could not correlate. I think it's not about SAR graves, but I think I could not correlate that some of those data points. So anyway, so there are a lot of employees caught in these companies, or many companies who are right now either going through sort of slow growth and they are sort of not delaying the joining of new batches, or maybe sort of getting rid of dead weight, or maybe just generically reducing even if the guys are good. So what should employees do in this scenario? Because the challenge is definitely for companies and for themselves as well. So what should they be doing at this point of time?
So I think there are three different parts to that, right? One is what should current employees do, and how do they derive some focus and stability of mind and purpose in these times. Second is what do sort of young professionals, those joining workforce new do, and then of course broader question for companies. I think if I look at companies and employees, I would say my general principle, and in number of our portfolio companies, I've been doing calls with the management and one down, precisely to kind of have that dialogue with people to say to give our perspective and to hopefully instill some confidence on why we still feel positive in these times. So I think a couple of important things, right? One is nothing is as bad or as good as it seems.
I agree.
Companies and careers don't get built in few months.
Correct.
But extreme fear or extreme exuberance does happen. It seems to be happening in a lot shorter cycle nowadays. And in some ways, this party is come to an abrupt halt because of a reason most of us don't understand. So I think there is nervousness to that extent, but nothing is as bad as it seems. I mean, in general, we are very resilient and we'll come back. Now, will it be in 3 months, 6 months, 9 months? That's anybody's guess. But one thing for folks to think about is outermost scenario, even if it's 1 to 2 years, frankly, it's a long time, but it's not end of the world. The challenging thing would be if people make short-term decisions, in the midst of this, which compromises sort of their medium and longer-term outlook. So whether it's looking at employees as an asset, or whether it's employees recognizing that this is an opportunity for them to really step up and shine. Crisis is actually a time for people to step up and shine. It's not easy to do that in normal times. So I would advise most people to do that with their existing, wherever they are, with their existing employers, so that they can stand out as a professional, and that actually helps them, build a solid platform for their own career, as opposed to being nervous about and looking out. Because right now the world around is anyway tough, and you have made a choice to work at a certain company because you're excited about that company. So figure out how you can shine there and really use this opportunity to deliver the company. And never ever are there multiple opportunities that exist for people to shine like a crisis. It's really an opportunity for folks to do that. I guess in case of new offers, etc., companies are making, I think that's a tough one, because for a lot of the companies, I guess getting a good stock, getting the right stock of survival and stability is important before they make commitment to sort of new things. And typically, I've seen the best companies give people a deferral and say, hey, give us some time to sort this out. Be as transparent as you can be without sharing confidential information. But I think it would be wise to defer it out a little bit to say, we will get our house in order in a couple of months and then be able to make a decision. But it's unfortunately something nobody controls. Having said that, I think we have selective portfolio companies that are actually hiring high quality talent in these times. And again, it depends on whether you have cash flow, how much you have been hit, and all of those things. But we have both dimensions going on, because this is also a time where you will find talent like never before.
I agree. Rightly priced rather than bizarre numbers we have seen all of last few years, right?
Yeah. So I think we are seeing all of these things in play, and some of them obviously are contradictory.
No, I agree, and I think employees also have to be sort of accepting the situation that salary structures will dramatically change. So if you're coming out of some leading institute expecting a salary of 30 odd lakhs, 40 odd lakhs, or even more, I think that's what our ET and others showcase, what kind of salaries they have. I think that sort of salaries will not happen for some time. So I think their expectations should change for some time for sure. Otherwise, they will be out of job for a pretty long time. I guess we are all in the same situation, I guess.
True. So very true. Yeah. Yeah.
Perfect. So thanks, Ganesh. I think the session was very, very sort of, for me, it was, there was a lot of knowledge for me. And I'm sure everybody who's listening will actually get a lot of new insights. So thanks, Ganesh, for joining us. And let's chat later on as well when things become much, much better.
Sure. No, absolutely. I hope next time we do this, we are in a much better world. And thanks for having me. I think this was great. Good fun.
Thank you, Ganesh. Thank you.